Hey everyone, welcome back to Corporate Decoder, your favorite spot to decode the secrets hidden in plain sight within corporate filings. Today, we're diving into Guru App Factory Corp's latest Q report, and let's just say it is a masterclass in how a company can, shall we say, be creative with its financial position. Before we crunch these numbers, if you love getting these behind the scenes looks at companies, hit that subscribe button. And if you want to hang out with other financially curious folks and bounce ideas around, our Discord server link is in the description below. Alright, let's get straight into it. This is Guru App Factory Corp's quarterly report, a document that is supposed to give us a snapshot of their financial health. But sometimes that snapshot looks more like a blurry photo taken in a dark room. And that is exactly what we're going to try to bring into focus today. So, what is the big picture here? This report covers the period up to the 31st of October 2025. We're looking at a company that is clearly trying to navigate some choppy waters. First off, they've checked the boxes for being a non-accelerated filer, a smaller reporting company, and an emerging growth company. This tells us they're not a massive player and are likely still in the early stages of their business journey. That is important context as we look at their finances. Now, let's jump into the actual financial statements. The first thing that grabs your eye is the balance sheet. Look at the assets for the 31st of October 2025. They have accounts receivable of just $13,000. That might not sound like much, but the kicker is at the 31st of July 2025, they had zero, and their total assets, a mere $30,000. That is incredibly lean for a company operating in the tech space. Then we look at liabilities and wow, here is where it gets interesting. They have advances from related parties. Think of this as money being loaned to the company by people connected to its management or owners. As of the 31st of October 2025, this amount was $18,303, a significant jump from $1,303 just 3 months earlier. This really underscores how much they're relying on internal support to keep the lights on. Their total current liabilities also swelled to $35,145 from just $1,303. This means a lot more short-term obligations have popped up. And then you get to stockholders' equity. Because their liabilities are higher than their assets, they have a stockholders' deficit. As of the 31st of October 2025, this deficit was $22,145, a huge swing from a small positive equity of $1,303 back in July. This isn't just bad. It means if the company were to wind down today, there wouldn't be enough assets to cover what is owed to creditors. Let's lighten the mood a bit by looking at the income statement. For the 3 months ending the 31st of October 2025, their revenue was $13,000. Now, this is compared to $4,500 for the same period last year. So, revenue did grow, but let's put that $13,000 into perspective. That is about what a small independent business might make in a decent week. Their cost of revenue also climbed from $2,500 to $7,500. This means for every dollar of revenue they brought in, a larger portion went directly into the cost of delivering that revenue. This brings their gross profit to $5,500 for the quarter ended the 31st of October 2025. Remember, that is before even paying for their general operations like rent, salaries, or legal fees. Speaking of operations, their general and administrative expenses, which include things like legal and accounting fees, jumped dramatically. They went from $5,556 in the same period last year to a whopping $26,342. That is nearly a 5-fold increase in just 1 year. And what happens when expenses rise much faster than revenue? You guessed it, a bigger net loss. Their net loss for the quarter ending the 31st of October 2025 was $20,842. That is a massive leap from the $3,556 net loss in the prior year's quarter. This indicates that while they're trying to grow revenue, their expenses are outrunning them significantly. Now, let's talk about your ownership. The number of shares outstanding remained the same at 7,106,000. This means the increased net loss didn't dilute existing shareholders' ownership percentage. However, that loss per S-share is still reported as $0, which again is a way of saying the loss is really small on a per-share basis. But the overall picture is concerning. The statement of cash flows is where we see the real cash crunch. For the 3 months ended the 31st of October 2025, they used $17,000 in cash from their operations. This is a stark contrast to the $2,326 in cash they generated from operations in the same period last year. They are burning cash, and at an accelerating rate. And how are they plugging this hole with financing activities? Specifically, they received $17,000 in advances from that related party we saw on the balance sheet. So the company is essentially borrowing from itself to fund its basic operations. The result, their cash and equivalents at the end of the period was zero. That is right, no cash on hand. This is a critical sign for any business. Digging into the notes under the organization and business section, Guru App Factory Corp tells us they were established in March 2023 and develop mobile applications and provide software development services. They also note the 31st of July fiscal year end. This is perhaps the most crucial note in any financial report, and it is especially stark here. The going concern section is where management has to state if there is doubt about the company's ability to continue operating, and they've been very clear. They state there is substantial doubt about the ability of the company to continue as a going concern for a period of 1 year. This is because they have no cash, a significant working capital deficit, and have been losing money. Their survival hinges on getting more money from their major shareholder or finding new investors. Without that, they might not be able to stay in business. And as we look at their accounting policies, it is important to note their revenue recognition. They recognize revenue when consulting services are performed or when an application is delivered and accepted. They also mention that all of their revenue for this past quarter came from a single customer. Relying on one customer is always a significant risk. Under related party transactions, they confirm that the $18,303 on the balance sheet as of the 31st of October 2025 is from their sole officer and director. This loan is non-interest bearing and due on demand, meaning the company could be asked to pay it back at any moment. This heavy reliance on insider loans is a common sign of financial distress in early stage companies. On the tax front, it is no surprise they have a full valuation allowance against their deferred tax assets. This means they don't expect to generate enough profit in the future to use up their tax loss carryforwards. Essentially, they have a lot of losses that could theoretically reduce future taxes, but management doesn't believe they'll ever get profitable enough for that to happen. Under capital stock, we see they've authorized a large number of shares, 75 million, with a very low par value of $0.001. They issued shares in March 2023, and then again for the year ending the 31st of July 2024, raising some funds. But the share count hasn't changed recently, and they're still issuing an outstanding 710600 shares. Now, let's turn to the management's discussion and analysis, or MD&A. This is where management gives their perspective on the financial results. They talk about their business model, developing mobile apps and providing software development consulting. They also mention generating revenue from app sales, ads, and in-app purchases. Looking at the results of operations, management highlights the revenue increase to $13,000 from $4,500 in the prior year's quarter, attributing it to the launch of their software development services. This is the positive spin, focusing on the growth. However, they also acknowledge the increase in operating expenses, mainly driven by legal and audit fees, which led to the higher net loss. In the liquidity section, they paint a familiar picture. Total assets are meager at $13,000. Total liabilities are significantly higher at $35,145. And that stockholders' deficit of $22,145 is a constant worry. They state they have no cash. This section really drives home the precarious financial situation. And the going concern issue is repeated here, emphasizing the substantial doubt about their ability to continue operating for the next year. They explicitly state their survival depends on financial support from their major shareholder and finding new financing. It's a clear admission of their vulnerability. Their plan of operation and funding section reveals they expect to use existing funds, further advances, and debt instruments to cover operations for the next 3 months. They have no lines of credit and rely on private placements of equity. The strategy seems to be continuous fundraising, which, of course, means more dilution for existing shareholders. Finally, under controls and procedures, the company admits that their disclosure controls and procedures were not effective. This means they're not confident that all important information is being properly recorded, processed, and reported in a timely manner. That is a red flag about their internal operations. So, what is the story here with Guru App Factory Corp? On the surface, they're a tech company trying to carve out a niche, but the numbers tell a much different tale. They have minimal assets, a growing deficit, and are relying heavily on loans from their own executives to stay afloat. Their revenue is growing slowly, but their expenses, particularly without obvious revenue, generating activities to justify them, are soaring. The going concern warning is loud and clear, meaning the company might not be around in a year without significant new funding. This isn't a company that is on solid ground. It is a company that is fighting for survival, relying on goodwill from insiders and hoping for a miracle investment. The big risk here is obvious. If that insider financing dries up, or they can't find new investors, the lights could go out. The opportunity, if it exists at all, is a long shot that depends entirely on attracting significant capital and proving they can actually generate substantial, profitable revenue. Overall, Guru App Factory Corp appears to be in a very vulnerable financial position. The path forward requires a major capital infusion and a clear, demonstrable path to profitability, neither of which seem imminent based on this filing. Alright, that is our deep dive into Guru App Factory Corp's latest report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more of these corporate deep dives. Don't forget to check out the Discord community in the description below. Thanks for watching, and see you next time.